Kotak Private presents Take and Counter-Take.
At the inaugural session of Kotak Private presents Take and Counter-Take, market veterans Sanjeev Prasad and Prashant Jain debated the central question: is India a safe bet for big investors? The session, moderated by Prashant Nair and Nilesh Shah, provided a definitive look at India's growth story and investment risks in the current market landscape.
So what is Take and Counter-Take? It is a curated knowledge platform designed to foster fresh perspectives and collective learning. Each session begins with a take, a viewpoint on a contemporary issue, followed by a counter-take that adds depth through complementary or contrasting insights. But together, they lead to a balanced and holistic view of what truly matters. While the world is coming to terms with new trade dynamics, compared to its peers, India is poised for higher growth and lower inflation. Recent government reforms and an accommodating monetary policy have helped withstand the impact of global volatility. However, foreign inflows continue to remain a challenge. There's no one-size-fits-all answer. Every issue invites both perspective, a take and a counter-take. And informed decision-making requires a thorough evaluation of multiple viewpoints. Today's discussion revolves around the theme: is India a safe bet for big investors?
Let's start with economic sweet spot and structural drags. Prashant bhai, you have championed India's sweet spot with 6 to 7% real GDP growth and our low export dependence shielding us from US tariff. How do you see this trajectory of GDP going, let's say, for next decade?
I think in my 35 years of this industry, I feel the most optimistic about the next decade at least. And there are 3 or 4 very simple reasons. One, I think post-COVID, as remote working has gained acceptance, non-software service exports have grown exponentially. And I think India has very little competition in that space. There is no country in the world which offers the largest pool of English-speaking people, technically qualified, digitally skilled, the ecosystem of services, and at our price points. What has happened, India's current account deficit has collapsed because of this. And that brings many other positives. I think we are also getting a second shot at manufacturing. We missed it the first time. I think we'll do better this time. Manufacturing is a much bigger opportunity. And we are making good progress in our areas of weakness. So 25% of Apple phones are being assembled in India, and we know companies are going public that are now suppliers to the largest aeroplane manufacturers in the world. If we can do well in our areas of weakness in electronics, I think we will do better in other industries like chemicals or ICE engines. We are doing extremely well. So I feel pretty confident about manufacturing as well. And finally, I think the government has never played a more supportive role than what it is doing today. So net, I feel quite optimistic. I think we should certainly grow between 6 to 7%. I think we have potential to grow beyond 7%.
Thank you, Prashant bhai. Sanjeev, you have countered with worries over job creation shortfalls, innovation deficits, and drags from sectors like textiles potentially capping growth below 6%. How do you forecast GDP trajectory over the next decade?
See, I don't dispute that 6-7% which Prashant is talking about is possible. Let's assume we grow at about nominal GDP of about, let's say, 10%. You take out 2-3% for rupee depreciation, 1% for population growth. So logically, we should add up with about 6 to 7% GDP per capita. The question is two over here. One is the mean itself. Look, a lot of countries, when they developed, had a lot of favorable tailwinds for them. Classic example is China. Between 2000 and 2025, China's GDP per capita growth was 11%. Every year, 11% GDP per capita. That is crazy numbers. And where did China get those tailwinds from? Effectively from two areas. One is massive participation in low-tech manufacturing. Huge number of people could find employment over there. And number two was a very favorable open global economy or globalization. Unfortunately, what we are seeing now is from India perspective, Prashant talked about manufacturing. We can do that. But there are few challenges over here. Remember, the world is not that much open now compared to what it used to be when China was developing. And second thing is the number of people which are required for manufacturing. Let's say when China was developing per unit of manufacturing, it is far lower now. Automation is coming in a big way. It's already there, by the way. Yeah? So the big challenge would be job creation in India. Second thing to keep in mind is the median part of GDP growth. When we talked about GDP growth, we all assume everybody will grow at 6 to 7% per capita. That I am not very sure is going to be the question, given the fact that you are seeing structural changes in the world, which makes it very difficult for a person who does not have any educational skills to get to that 6-7% growth rate. So mean growth, 6-7% GDP per capita, possible. Median, I am not very sure about that. Keep in mind the fact that even if you look at US, by the way, the median incomes have actually not grown very high in the last 30 years, by the way, now. Yeah. Look at the wealth concentration in the US. It's absolutely mind-blowing. I have some numbers with me. Top 1% has 31 or 32% of the total wealth of US. The next 9% has another similar 32, 33%. And the 50 to 90% has another similar 30 to 33%. The bottom 50% only owns 2.5% of US's wealth, by the way. Is that a world where we are heading to? That is my bigger concern. Yes, we can grow, but will everybody grow along with the growth in India? That I'm a bit cautious about.
And let me just add one more point to what Sanjeev said. See, I think, again, yes, wealth concentration is a given in the world because you are developing global platforms and anyone who owns that. But look at absolute levels of wealth. Is it improving for the poorest of the poor? I think yes. And that is what really matters. If someone becomes worth $5 trillion, yes, the overall wealth has grown and your concentration will rise. And let me give you one simple statistic here. In 2000, blue-collar salary in Mumbai was 4,000 rupees a month. A starting software engineer's salary was about 30,000 rupees a month, 8 times that. Today, the both have converged. There are far more blue-collared in India than white-collar. Only 25% of Indians earn a fixed wage. That number globally is 50 to 75%. So I feel very optimistic about the rising purchasing power of blue-collared workers. A gym trainer, a plumber, an electrician is probably earning more than many software engineers. So I think if you think of it that way, I would not get too disturbed by this rising wealth inequality. I think income levels continue to rise in the country.
So the bigger debate which India has to have is, why are we satisfied with 6-7%? I mean, we need to aspire.
But are we satisfied? Are we satisfied, Sanjeev? Why are we? It's a statement or a question?
No, if you look at the numbers, no. I mean, we have been in that range for a long time. And are there sufficient catalysts out there which can trigger a higher growth rate?
You think there are, or you don't think there are?
No, doesn't look like, unfortunately. I mean, there are a lot of things which can be done, but at this point in time, no.
Prashant, do you think potential is much higher, but do you think it will happen?
See, one opportunity is there for India. If in India's oil imports, I think, have come down from 6% of GDP 15-20 years back to about 3%. And that is a structural improvement. If in 10 years we can move to EVs, if storage becomes cheaper, people have lots of things, but we have solar energy. And it is the cheapest solar energy in the world. So if we can make the transition from fossil fuel vehicles to EVs over time, I think India can have a shot at becoming a current account surplus economy. And if you do that, I think your growth rates can meaningfully accelerate. I think it is still 5-10 years away, but that possibility is there.
Sanjeev, you want that India's 20 times forward earnings risks erosion due to variety of things, lagging R&D, and of course, China's at still 13 and a half odd times. So you're saying flat returns are possible for the next 1 to 2 years, right?
The issue over here is if you look at sectors and stocks on a more individual basis, more on a bottom-up basis, it's very hard to really find value in the market beyond, let's say, the financial names which are trading at reasonable valuations. Most of the PSU banks are at about 1 time plus minus. If you look at the private banks, around 2 times plus minus, look reasonably valued. But beyond that, let's look at each of the major sectors. All the consumption stocks are north of 40p, 40 to 70p. For the kind of growth rates they're delivering, it makes absolutely no sense. No DCF model you can get to 40, 70 P, by the way, with 5-7% growth. So that's the big issue over there. So on a bottom-up basis, it becomes very hard, to get too excited about Indian market currently. On a top-down basis, 20p is actually not bad. Even if you look at the last 5 years average, at 20p, it looks okay. Now coming to some of the comparable countries, if you look at, for example, China is about 30.5, Korea is about 10 times, and which is what is attracting the foreign investors there. And plus, they have companies which play on the emerging themes. The 2 biggest themes I would say is AI and everything which goes in AI, and the second one is biotech. Unfortunately, in India, we do not have any company which plays only of these big 2 themes in a big way, which is why foreign investors are saying Indian valuations are high. We don't find exciting enough stories over here. So for the time being, we're happy to look at other markets which are trading at cheaper valuations and have a lot of exciting plays.
Prashant, the weigh in on that. Do you believe the pullback that we've had sets us up for a more steady sort of compounding? And what would it take? Because I think this will be the 3rd year. It kind of goes back to the nominal growth fact. 3rd year when nominal growth will be under 10%, and that needs to pick up because earnings growth is dependent on that.
On IT, yes, the AI threat is there, but only time will get us the right answer, but I feel that AI will lead to significant productivity improvements. But I think the tech spends will not go down. So if I'm spending $100 as a customer, I may get more value for that $100. I will save that money somewhere, but my tech spends are unlikely to go down, and which is what really matters for Indian IT companies. So I think, and I could be wrong there, I think they will continue to exhibit low but positive growth rates. I think one very important thing has changed in India, which we can actually trade at a premium to our past multiples. The fixed income in India is now taxed at marginal rates. So the gap between fixed income and equity returns post-tax has gone up sharply. So I think this local flow of capital to equities should sustain. And an effect of that is that the volatility of India's markets has collapsed. India used to have a beta of more than 1. Today that beta is less than 1. So I think India in some ways is becoming a defensive market. The cost of capital has fallen both for local and for foreign investors. The dollar premium is now close to all-time lows, 2% a year. So I feel if you look at India X of these consumer companies, X of retail companies, which weights are small, but the multiples are so high that if you look at Indian markets, X of these, they look a lot more reasonable.
Kotak Private presents Take and Counter Take. Kotak Private presents Take and Counter Take.
Coming to the global decoupling versus looming threats, there is potentially US recession and a bond yield spike. US tariff, we don't know when the deal will happen. There is also geopolitical risk. So let me take, Prashant, by your take on it. Will we get decoupled? Or Sanjeev, by you can then add on, will we get dragged down by what happens globally?
So Nilesh, I have always struggled with this because I have never seen the coupling between India and rest of the world in terms of the economy. Even in the Lehman year, you grew 5.5%. So I have always struggled with that. Yes, our markets have been coupled in periods of crisis like 9/11, Lehman, COVID, global markets collapse, we also fell. But it was great opportunities to invest. I wonder if the next crisis happens, since markets are now driven by local capital, whether even those deep corrections will come. But I think India's depend. See, if you have failed as a goods exporter, it makes you resilient to a global downturn in economy. And service exports have not really degrown except for the COVID year, small degrowth. So I feel that we should not worry too much about global economic conditions.
Nowadays, IPOs have become hot topic, and fund managers have become like ping pong ball. On one side, issuers and private equity managers complain that mutual funds are doing cartelization. On other side, on social media, investors are complaining, how are these fund managers buying these stocks? This is despite the fact that after listing, a broker's market cap is bigger than stock exchange's market cap. So let's come to the IPO market, Prashant Bhai. You have praised our IPO markets for channeling funds to entrepreneurs, fostering market health without froth. How do you see this with elevated pipelines in IPO? How will it influence liquidity, valuation, and sentiment? Will it be a booster or will it be a break?
I feel that in majority of these issues, investors over long periods will lose money. The expectations are likely to be unmet because we are seeing many weak quality, average quality companies with suspect fundamentals or not so great fundamentals going public at crazy valuations. So I think in a lot of these issues, long-term expectations will be not met. At the same time, on the positive, I think from an economy's perspective, it is positive because all kinds of entrepreneurs, large, small, good, bad, I mean, everyone is getting lots and lots of money. And we do see 1 in 10 companies have real capabilities. And if 1 in 10 of these issues, these companies scale up meaningfully, I think it will be great for the economy because ultimately in the today's day and world, it is the companies that make a country and not vice versa. So first time in my career, we see so much of capital being created. Investors may or may not make money, but I think money is moving from millions of hands to few thousands of those promoters, and I think some of them will do exceedingly well. That's why I think the country should do well. It should support growth. It should support innovation, and that's why I feel in the overall context, these are good times for us.
Sanjeev Bhai, you have cautioned about a silent shift where supply of IPO does curb the overheating, but it can create risk for the retail or other institutional investors. What's your take on this?
I'll give you some data to start with. If you look at the last 5 years, 21, 22, 23, 24, 25 calendar years, roughly about $100 billion have been raised in the primary market. Okay. Out of that, only 60% is actually primary money being raised for doing something with that money. 40% is actually offer for sale, which means promoters are simply cashing in and going out basically because they find the valuations on the higher side, but there are enough number of people who seem to be willing to buy the companies. Now, if you look at out of the $60 billion which has gone into companies, if you look at the use of proceed, it's very disheartening. Only 15% of the money has actually gone into creation of plant and machinery. The rest of the use of proceeds is all random stuff like retirement of debt, working capital, this, that, which have all been created. So the problem with the IPO market is, it is, I don't know whether resulting in real assets on the ground. Now, if you go back 2 decades, a lot of money was raised in the primary market for creating assets, core infrastructure sectors, metal mining, electricity, metal mining, oil and gas, roads, telecom, and so on and so forth. It's a separate issue. Many companies turned out to be dirt, zeros, went bankrupt, all that stuff, but assets got built. This time around, the IPO market seems to be providing exit to the PE guys, promoters, and so on and so forth. Even in the secondary market, I'm seeing the same issue, by the way. If you look at the numbers, roughly I'm talking about calendar 2025, the domestic institutional investors have bought somewhere about $77 billion worth of stock, by the way, which is a crazy amount of money, $77 billion worth. Against that, the foreigners have sold about $23 billion in the secondary market, which means somebody else has sold about $53 billion, because secondary market money has to be zero, somebody has to buy, somebody has to sell at all price points, which means somebody else has sold about $54 billion of stock. And who is that somebody? It's basically the same, the PE guys, the promoters. So in a way, both the primary market and the secondary market are being used to provide exit to the PE guys, the promoters, at maybe high valuations. And who are the people who are buying? It's ultimately the retail investor who is buying, because whether it's a mutual fund or a life insurance company or a retail investor directly, it is the retail investor who is buying all these names. So whether it's a good thing or a bad thing, only time will tell. But at least looking at the kind of valuation many of these companies are being IPO'd at, or the valuations at the exit, in the secondary market is taking place, because valuation high, we all know that, right? I don't know, it looks like a lot of transfer of, equity from smart people, I should say, within brackets, which is your PE guys, promoters, to the retail investors. So I don't know whether that's a good sign, I would say.
So, ladies and gentlemen, once Prem Vatsa mentioned that India is a country where opportunities are hidden and risks are visible. In China, it is the opposite. At Kotak, we have tried to give you take and counter take on relevant issues. Both risks and rewards are highlighted. Hope you enjoyed the evening. Please give a round of applause for our two great panelists.
Kotak Private presents Take and Counter Take.